Wall Street is zeroing in on the upcoming Federal Reserve Symposium in Jackson Hole, Wyoming, with keen anticipation. Investors across the board are eagerly awaiting any hints the Fed might drop about possible interest rate cuts, moves that could send stock markets soaring even higher. But here's where it gets controversial. Will the Fed actually deliver on these rate cut expectations? Or will Chair Jerome Powell take a tougher stance? This year's high-profile meeting occurs right after a week of mixed economic data that has left many scratching their heads. Recent reports on consumer prices, influenced in part by cheaper gasoline, seem to suggest the economy is holding up despite President Donald Trump's aggressive import tariffs. Yet wholesale price metrics show inflationary pressures persisting, muddying the picture further. All eyes will be on Powell's speech this Friday, which will be the centerpiece following a relatively quiet week in terms of new data releases. Last week's figures confirmed that American consumers remain resilient, continuing to spend steadily, while the jobs market continues to show strength with low unemployment claims and a healthy flow of new jobs. Despite this, a notable faction of investors worries Powell might use the Jackson Hole platform to cool down expectations for imminent rate cuts. Expectations that have already propelled indices like the S&P 500 and Nasdaq to fresh record highs. These investors point to stubborn inflation indicators as their reason for caution. Stephen Sosnick, a market strategist from IBKR, sums up the tension. We have a lot riding on this event. It could be a defining moment this year. But what if, once again, the market is gearing up for a dovish Powell and instead gets a hawkish tone? The Federal Open Market Committee is still priced in by futures markets to cut rates twice more this year, starting possibly at the mid-September meeting. But there's a growing debate about whether this optimism is premature. Certain sectors stand to gain the most from lower interest rates, particularly those sensitive to borrowing costs. Andrew Sliman, head of Applied Equity Advisors at Morgan Stanley Asset Management, highlights homebuilders, cyclical stocks, industrials and materials companies as primary beneficiaries. Indeed, shares of major homebuilders, PulteGroup, Lennar and D.R. Horton have surged dramatically over the past week, with gains ranging from 4.2% to an impressive 8.8% as of midday Friday. These increases notably outperform the broader S&P 500 index, which rose about 1% during the same period. When looking at the past month, the contrast is even starker. Homebuilders have enjoyed rises between 15% and 22%. Dwarfing the 3.3% gain of the overall market. However, these companies' future success heavily hinges on the trajectory of mortgage rates. Recently, yields on 10-year Treasury bonds have ticked upward, threatening to reverse the slide in borrowing costs that boosted the homebuilding sector so significantly. An often overlooked tension lies in how Powell's remarks might influence market sentiment. If he emphasizes inflation concerns over more optimistic economic signs, it could undermine these sector gains. Sliman warns, the more we see homebuilders rally, the clearer it becomes that the market expects rate cuts. So any suggestion at Jackson Hole that rate cuts are off the table could trigger vulnerability and a potential sell-off. Powell faces a challenging balancing act. He must reassure markets that the economy is in a Goldilocks zone, not overheating, but also not slipping into recession, without triggering undue fears of aggressive tightening or expansive stimulus. Ashwin Alankar, who oversees global asset allocation at Janus Henderson, points out, Powell can't spook investors by indicating the Fed thinks the economy needs heavy stimulus. That would rattle the markets. Interestingly, some analysts say the market's mood is already shifting. Thierry Wisman, a strategist at Macquarie Group, noted that only a few days ago, talk of a mega rate cut was common. But now, expectations for a more modest, cautious cut in September seem more realistic. This subtle realignment makes Powell's comments all the more critical, especially as the market approaches a generally quiet late summer period with few fresh catalysts. The recent string of strong second quarter earnings is coming to an end, and volatility indexes have slipped to their lowest points of the year, exposing markets to greater swings if surprises emerge. Jeff Blazek, co-chief investment officer at Neuberger Berman, highlights this lull. The calendar is getting pretty quiet, making Powell's message a focal point for investors seeking direction. Yet perhaps the greatest risk lies in the market's own complacency and optimism, which have propelled prices higher despite a backdrop of ongoing tariff worries and mixed economic signals. Sosnick cautions, the more confident and smug the market feels going into this event, the bigger the risk it overreacts if the Fed's message isn't what everyone is expecting. So, what do you think? Will Powell soothe investors and keep the rally alive with hints of rate cuts? Or could his speech light the fuse for a market correction? Is the market's optimism well-founded or dangerously overblown? Join the conversation and share your views, because this Jackson Hole gathering could well be the most important event shaping the US economy and stock markets in the months to come.